Hi, I'm Eric.
And I'm Dick. We are the Annuity Guys.
Dick, we've talked about rising interest rates now for a couple of years, but it seems like it might just be coming here very soon. So we've got all these different kind of financial products, stocks, bonds, annuities. So what's these rising rates? What are they going to do?
Well, Eric, again, you know, we have been talking about this really for about 5 years, along with everyone else.
That's right.
That the Fed says just around the corner, interest rates are going to be rising.
Or maybe not. It's imminent, but possible.
Well, there's, again, so many factors that are causing everyone to have the jitters and to believe that rates are going to rise. And I think we want to talk about how this is going to affect folks in all of the areas of their portfolio. And when you start thinking about stocks and bonds, first of all, we pulled the QE away. So the quantitative easing
here in the
United States, yes. So that there's not money, flooding into the market right now this way. That has an effect. But when you start talking about raising interest rates, volatility starts to go crazy in the stock market.
Right.
We have just been so fortunate over the last several years to have very low volatility. And folks aren't used to it when the market starts dropping by large amounts, rising by large amounts. And we're seeing a little of that more recently. So as we look at what's going to happen with stocks, I believe we're just going to see a lot more volatility and a lot more probability for some corrections.
Well, and I think it's, for lack of a better way, nobody wants to get caught with their proverbial pants down, I think is the problem. You don't want to be caught holding, all these equity positions that are at all-time highs if all of a sudden we're going to have a correction. And I think everybody's kind of sensing it, knowing that if we get this little bump in interest rates, what's going to happen? Well, because yield, if you look at the yield on stocks right now, the dividends that stocks are paying are very competitive to what the bond markets are paying. So would you rather own a stock paying 4% yield or a bond paying 3%? Well, what if that flip-flops all of a sudden and your stock prices start to drop because people say, I'd rather be in the safety of a bond and I'm going to sell out of this. Well, what if everybody starts doing that and then all of a sudden the market moves this way?
Right, and it's just common knowledge that bonds have an inverse relationship to interest rates. So a lot of times when the stock market gets volatile, folks start to go, my bonds, I'm going to put money into bonds. But when interest rates are rising and they have no place to go but steadily up, then even incrementally, it's going to affect bonds proportionally.
Oh yeah, if you own a 2% bond today and rates are going up, and if you wait, all of a sudden next month there'll be a 3% bond. Well, shouldn't you sell your 2%er now and get what you can and buy the 3%er when it comes out? And that's what I think people are trying to anticipate when all this is going to happen. And you're seeing people, as something moves just slightly, everybody's like, oh, no, I need to get out. And that's really, it's a concern. It's you want to have that flash drop because of what the Fed's going to do.
Exactly. And recently we've had one of the best jobs reports we've had. In May we had inflation heating up. So, Janet Yellen has been talking consistently about, the next interest rate rise that's just around the corner.
And I've seen some really interesting videos on Janet, and I call it Fed speak, that being translated into kind of normal English for the rest of us. And it's like, we're going to do this or maybe not. There's a lot of hedging going on.
Yes.
They know how kind of much the market's on that tipping point. And when they do start to move these numbers, it's going to have a drastic effect. And they're trying to get people to just ease in, it a little bit and anticipate it so that the market doesn't have a huge correction or nobody overreacts when they start to move these numbers around.
Certainly. I agree. And I look at the comparing now, thinking about stocks and bonds, that we know that bond values fall when interest rates rise. We know that stocks tend to get a lot more volatility and drop somewhat. So looking at the market, where it's pretty much sitting at all-time highs, and thinking about, well, what happens with annuities when interest rates rise?
Yeah, and that's a great. Typically, we start to see improving benefits to usually rate crediting, interest crediting and potential. You start to see increases, obviously, in what they're offering and get reoffered on an annual basis.
Yes.
Depending on the crediting term, you start to see better benefits, better potential. Now,
yes.
The nice thing is, even if you're tied to an indexed annuity and you see a correction in the market, you get the zero, obviously, but you're typically then resetting at that low point, and you're poised to take advantage of future gains.
Correct. So I believe that when folks are looking right now at a situation of do I adjust my portfolio, I think that it's a good time to really look at annuities and say, this is one place that I can go for my long-term retirement picture, that I can build a foundational portion for this portfolio. Just by adjusting my portfolio, kind of looking at annuities as taking the place of the bonds or some of the bonds, and giving me additional longevity, risk protection, insulating me from the bond market, knowing that this is the portion of my portfolio that's going to take me through the next 20 to 30 years of retirement, and also understanding that annuities are not insulated from interest rate increases. They benefit from them. They also protect you from large decreases in many ways, because they've got certain guarantees that are built into the annuity. So that's why it's so important, folks, that when you're looking at an annuity, does it meet your retirement objectives on the guarantee side? So if it meets it on the guarantee side, then the interest rate side, when it's favorable for the indexing or any other component that's variable, it's just going to be additional help, to your retirement.
Well, and as I kind of position out there, if you're looking at the fixed or the fixed indexed, isn't it nice knowing you're just going to take the losses off the table?
Correct.
And that's what you're looking to do. Insulate yourself from going backwards, whether it be from a bond market correction, from a stock market correction. Take the losses off the table. So as a retiree or a new retiree, not having to try to be hopeful that you'll have to regenerate, a 20% return because you've taken a 10% loss. Getting those pieces out, having that security in place is the first step. And then obviously, as we refer to, income guarantees are usually first and foremost in retirees. And so if you've got the combination of no losses with some additional guarantees, you're pretty well positioned for retirement.
And I think, Eric, just kind of in summary, if your portfolio is really properly balanced, you won't be concerned about an interest rate rise. You'll welcome it.
Yeah, if you'll protect your foundation, only things can get better.
Agreed.